Well, over the course of the last couple of weeks, we've seen the Fed make pretty clear statements that they're intending to cut relatively aggressively in the face of a reasonably strong economy and continued elevated inflation pressures. That sort of over easy policy is the type of policy that will likely continue to drive growth and inflation to be pretty strong. I mean, already, even before the easing cycle started in the US, growth was running at something like 3% on a real basis, and inflation remained elevated compared to the Fed's mandate. And so, further easing in the context of an already hot economy with, low unemployment, strong wage growth, and strong nominal GDP growth will only add fuel to the fire. And if anything, increases the risk that we transition in the U.S. from what has been mostly an income driven expansion to one that is further fueled by credit growth and increased borrowing in response to lower rates on the short end.
Right. And so, Bob, how are you looking at your asset allocation strategy, if at all, and what are you advising clients to do in this environment?
Well, it's pretty unusual for a developed world central bank to ease so aggressively when economic conditions are as strong as they are today. But you have seen that sort of path in emerging economies through time. And the market action is pretty clear in those sorts of scenarios over time, which is to see stocks strengthen, gold rally, and bonds sell off in comparison. And that's basically what we've seen over the last 4 weeks. Today, of course, it took a bit of a breather based on this geopolitical news, as well as a bit of the flow through of falling oil prices. But the general trend is pretty clear, which is that the Fed is continuing to ease.